This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Lee back on the show. Now, joining us again in the Postgame segment is Nick Galarnik. Now, let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Lee's picture saying, looking for the downloads. Now, Eric, let's get to crude oil.
There was no EIA inventory this week due to what they described as a system upgrade. I'm not sure exactly how it's an upgrade to not have the data, but that's what they called it. So we'll have EIA data for you next week. Meanwhile, API reported a build on inventories, which of course is a bearish sign, and needless to say, the market action was very much bearish this week. As Lord Keynes famously said, when the facts change, I change my opinion. And the facts are definitely changing, as is my opinion, on the risk of a major upside move in oil prices. But let's start by breaking down what's happened in the last week. On Friday, Hezbollah announced just before the U.S. markets opened that it held the United States directly responsible for the violence in Gaza and vowed that the United States would, quote, pay a very heavy price after explicitly acknowledging the U.S. Navy assets in the Mediterranean and saying they would not deter Hezbollah from making good on its threats. But then oil sold off $3 on the day, evidencing that the market is ignoring those threats. On Sunday's futures open, OPEC Plus and Russia both confirmed intentions to extend production cuts through the end of the calendar year. That was obviously bullish, and the market responded with a $1.50 rally in the Asian and European sessions, but still sold off hard in the U.S. session to close approximately unchanged on Monday. The real carnage in oil markets this week started in the overnight session after Monday's close, when both gold and oil nosedived as war hedges collapsed, signaling that the market agrees with several of our recent guests that my own concerns about military escalation are misplaced. The 100-day moving average was taken out to the downside early in the Asian session. A brief attempt at recovery began with the European Open, but didn't last. And by the end of the U.S. session on Tuesday, WTI was down more than $5 from its peak on Monday morning, after the bullish news from OPEC Plus and Russia. It's not clear to me exactly when the news first broke that both the United States and the European Union were now pressuring Zelensky to make concessions and negotiate a peace agreement with Russia, reversing their prior commitments to support Ukraine in its fight to the end, no matter what it takes. But it is clear that this news played a big role in bringing on the onslaught of selling in both crude oil and gold as geopolitical risk hedges utterly collapsed. I suspect those moves also triggered algorithmic CTA funds to short oil and gold, and that activity helped accelerate the downside move in prices. By the close on Wednesday, Brent was below $80, and WTI had briefly tested a 74 handle after slicing through both the continuation and contract 200-day moving averages like a hot knife through butter. The market closed on Wednesday well below those 200-day moving averages, portending the risk of further downside still to come. Remember that even Dr. Anas Al-Haji, who disagreed with my concerns over military escalation, told us that he expected OPEC Plus to defend $80 Brent, and we hit that level on Wednesday. There isn't much in the way of technical support levels below Wednesday's close before you get to the 200-week moving average, all the way down at 69.93. So if OPEC Plus or Saudi Arabia is going to intervene, they better do it quickly to avoid even more downside carnage. Taking the opposite view, our friend Rory Johnston tweeted on Wednesday a strong warning that he thought a cut from OPEC Plus was foolish, wishful thinking on the part of crude oil bulls. Rory argued that, if anything, a fourth production cut this year would support the bearish argument that the supply imbalance is actually opposite what everyone, including Rory, thought it was, i.e. too much supply rather than not enough to meet demand. Even more bearish news emerged Wednesday when it became clear that a disagreement had formed between Biden and Netanyahu, who reportedly ignored Biden's request for a temporary ceasefire. Secretary of State Blinken later remarked publicly that an Israeli occupation or annexation of Gaza was not an acceptable resolution to this situation. From my perspective, the market took this as a reversal in President Biden's prior unconditional commitment to support Israel no matter what. And I'll be the first to say that Israel getting into a military conflict with Iran by itself doesn't pose much risk to global oil supply. The risk was from the United States being involved in a major conflict with Iran that would risk direct warfare escalation between the United States and Russia. And this rift between Biden and Netanyahu seems to have calmed any remaining fears that such an escalation was possible. All this obviously forces me to reevaluate my own concerns about a full-on military conflict between the United States and Iran developing, and potentially evolving to a United States-Russia direct conflict. Frankly, I still think the market is badly underpricing that risk, but recent market events have caused me to recognize that the risk probably isn't nearly as imminent as I first thought it was. With 2 aircraft carrier battle groups, a few guided missile cruisers and destroyers, and at least 1 Ohio-class cruise missile nuclear submarine, all pointing their weapons directly at Iran as a deterrent, it's no great surprise that Iran is in no hurry to escalate a military conflict with Israel, at least not right here and right now. But I'm still quite convinced that neither side can ever forget what has already happened, and that Hezbollah has made it crystal clear that they will hold the United States directly accountable for the loss of life in Gaza. So I remain convinced that Hezbollah and/or Iran will make good on their threats to seek revenge against the United States. But it would make much more sense for them to accomplish that goal by infiltrating the United States through its open southern border, and then planning and executing a terrorist event on American soil long after all the U.S. battleships have left their present station in the Mediterranean. That would still lead to a direct military conflict between the United States and Iran, which could easily escalate to direct conflict with Russia. But it would happen long after the basket of calls on March 24 WTI futures that I was holding would have expired in mid-February. So the change in my own geopolitical risk hedging strategy has been to diagonal roll my calls to lower strikes and later expiries, to give all of this more time to play out. A couple more news events went seemingly unnoticed by markets on Wednesday. Yemeni Houthis engaged in conflict with Israel claimed victory for shooting down an American MQ-9 Reaper drone, and hours later, U.S. warplanes conducted attacks on eastern Syria. Messaging from the White House was vague about exactly what acts these air raids were retribution for, but the point is, U.S. forces are still very much engaged in this conflict, regardless of the reported spat between Biden and Netanyahu. Separately, Russian Foreign Minister Sergei Lavrov made comments to the effect that the United States was risking a major Middle Eastern regional war by its actions of supporting Israel. So while the oil and gold markets seem to have completely forgotten about any risk of escalation to direct military conflict between the United States and Russia, it's crystal clear that Russia has not lost sight of that possibility and remains concerned by it. And as I said last week, my view is that the world desperately needs more spare capacity to leave room to compensate if significant supply is eventually taken offline by military events in coming months or years. So if Saudi Arabia, either independently or through OPEC Plus, further cuts production to support the market here, I will salute them for doing so. Rebuilding spare capacity is critically important, and prices are now low enough to allow doing so. But at the end of the day, all of these events add up to demand a change of my own opinion that a major escalation with Iran before mid-February, when my out-of-the-money calls would have expired, was the more likely case. Now, I still see that possibility as entirely plausible, but it's no longer my base case, and I'm repositioning accordingly. I've already taken a big loss on my basket of out-of-the-money calls on the March WTI crude expiry, and I'm now diagonal rolling that position into a smaller-sized basket of calls with lower strikes and later expiries. I remain steadfastly convinced that the market is being too complacent here, and that Hezbollah and Iran will eventually make good on their promise to seek revenge against the United States. But that could take a year to play out, so betting the farm on $150 oil prices by mid-February just doesn't make sense anymore. We're already at a price level where OPEC Plus intervention is entirely possible. But without it, I think there's likely to be more downside still to come, unless the geopolitical situation re-escalates, which is also entirely possible. A smaller number of calls, much closer to the money, makes much more sense given this change of the facts.
Eric, what a breakdown on that 50-day moving average. I was looking for a retest of the $80 level, which was where the 2023 highs were. But this selling has truly intensified. It may just be the fact that everyone was so positioned bullishly on oil due to the escalation of events that it's really easy to squeeze everyone out. What will be really the big tell for me is going to be in the next week whether if this was just a big washout of buyers, then we should see the price rebound back to $80 quickly. The way I look at it is the longer we spend below $80 on a sustained basis, the more likely that the bull phase has paused and we're going to go back into some sort of a trade range that was established all year long. With that said, let's move on to the equities. Eric, what do you see here on the S&P?
The 100-day moving average at 44.29 is the next test for this rally. A lot of people are saying that this has mostly been a short squeeze and that that's over now. Well, time will tell. We'll see what happens.
All right, I want to get your opinion in here, Nick. What levels are you watching on the S&P going into next week's OPEX?
Yeah, Patrick. On SPX right now, spot price is 43.80 approximately. We have a call wall just above at 4,400 and a put wall below at 4,300. The implied move for the November 17th monthly OPEX, which is next Friday's OPEX, is plus minus 65 points. Thus, the implied upper move would be 44.45, and the implied lower move would be 43.15, approximately just above that key support area of 4,300. Now, I'm inclined to think that watching the volatility decline into the monthly OPEX, we probably see some range-bound action. However, next Tuesday and Wednesday, we have core CPI and then PPI on Tuesday and Wednesday, respectively. That will likely cause a large movement in markets into monthly OPEX.
Yeah, it's interesting. That's that big thing of will the gamma pinning prevail or will the headline inflation drive that volatility? It's certainly the thing to watch. What we do know is that the shorts got squeezed. I mean, there was some historically high levels of short positioning, and everyone is now being forced to cover that. That has been the tailwind, including a Vanna influence from the OPEX that has driven this rise. So the question now is, how do the bulls hold the line during a consolidation phase? The way I look at this is that if during any pullback, 4,300 more or less contains almost all pullbacks, then it's very likely that we have seen the low of the fourth quarter and that a trade range going into the holiday season becomes the prevailing trend. I still overall am bearish this market, but if this does consolidate in here, then it really looks like it's going to be a 2024 story. Moving on, though, what levels are you watching on the Qs?
So right now, spot price on the Qs is approximately 373. We have a call wall above at 380 and a put wall below at 365. The implied move for the November 17th OPEX is plus minus 8 points. Thus, the upper expected move is 381 and the lower potential move is 365. Key resistance right now is above at 380 and key support is just below at 365. Again, as I mentioned in past weeks, I'm hesitant to go long on big tech because a lot of these big names are very, very overvalued in my opinion. Right now, what we're seeing is we're seeing a lot of pausing in the call walls on certain names. Only about half of the Mag 7 names have a call wall just above the current price. Like Apple, for example, has a call wall at 185 now. which has moved from 181 or so. So there may be a bit more upside perhaps in the short term, but I'm hesitant to add long. I still do think that in order for this rally to have legs, we need to see the small caps outperform. Last week, they outperformed handedly. This week, they're underperforming, however. But I'm watching IWM primarily for the upside action. And again, a paired trade, I think that would be probably pretty strong into the end of the fourth quarter would be short Qs and long IWM.
Well, that's an interesting perspective. The one thing that I would agree with is that if we were to have a trade range into the tail end of the year, and if it came in with the highs in yields and the bond market generally calming down, what we could end up seeing is that sector rotation out of the Mag 7 and into those incredibly beaten down bond proxies and high dividend yield areas, or even the beaten down small caps like you were suggesting. That kind of rotation would also likely keep the index far more range bound, as the Mag 7 plays such an important role from a market cap perspective, driving the upside. And that's a very premature speculation on whether that's the scenario, but it is certainly something to watch as we move forward here. The moving on though to the VIX. And the VIX collapsed. I mean, that was a vol crush. And that certainly created the Vanna tailwind for the market as dealers were buying back substantial short positioning on their hedges that contributed to that rocket higher. But here we are on the 14 handle on the VIX. And while we certainly can have a very low VIX over the holiday period, which tend to have low volumes and far more range-bound market, I'm actually surprised we're this low this quickly. Do you think we get to the 13 handle? What's your view here on the VIX?
With the VIX right now at approximately 1450, Patrick, we can expect about roughly 0.8% moves top to bottom intraday on SPX. What I'm looking at right now is a possible bottoming at around 1213 if we do continue higher into year end, and also if the CPI and PPI numbers come in line, which would probably lead to a further market rise, perhaps. However, the one thing I'm noticing that's very interesting is that we've contracted in just about 1 week or so from last week to this week. We were seeing ranges as wide as 51 points or so on average on SPX. This week right now, we're seeing ranges around the 30-point range, which is very interesting to see how fast that contraction in volatility has occurred. That doesn't necessarily denote that we're going to see an expansion in volatility outside of some exogenous event coming out of left field and causing a pop in volatility and a corresponding decline in broad markets. But right now, I'm hesitant to go long on options because I think that it's possible we kind of do sit in this narrow range or drift higher, toward around 4450 perhaps, possibly stay in this range between 4300 and 4450, and it may just keep bouncing back up and down and causing a lot of confusion for bulls and bears. Now moving on to page 7, we have the US dollar index. What are your thoughts here?
We're back in the 105 to 107 consolidation range after just one daily close below 105 hinted that perhaps lower numbers are still to come. But so far that looks like a fake break, and until the market moves below 105 or above 107 and stays there for a few days, we're still in a sideways consolidation.
Eric, for me, when I look at the dollar and this consolidation, it fits that bigger intermarket risk-on narrative, which is typically rising dollar stresses risk assets, and a dollar in consolidation is a tailwind for risk assets. And so if we are going to have a period where the remainder of the year is far more of a calm market environment, then the dollar being in consolidation fits the bill there. I just don't anticipate the pullback being very deep. Looking maybe at worst down to 104, but the 105 level could very well be the bottom of the range, particularly if we see the US dollar yen ripping north of 152, as all the cross currencies may not be moving in unison. It'll be interesting to see, but I think a further consolidation will just lead to an interesting buy-on dip in the dollar index.
Now moving on to page 8, we have the gold futures chart. Eric, what are your thoughts here?
We're approaching a really critical level here around 1950. First of all, the sell-off was easy to see coming if there was a geopolitical de-escalation, and I explained that in last week's commentary. So we got the de-escalation, and therefore we got the sell-off in gold, just as I predicted. But here's the curious part. At the same time as geopolitics were de-escalating, a very strong consensus was forming in macro circles that the bond market bottom is in, and therefore real rates have peaked. I'm not sure I agree that the final bottom is in for the bond market, but the fact that consensus now thinks that real rates have peaked was a huge buy signal for gold, confirmed by quite a few notable pundits making that buy call on Monday and Tuesday. But gold continued to sell off hard through Wednesday, despite the very bullish sign that real yields may have already peaked. The only explanation I can come up with for why that would be happening against the macro news is that CTAs have a massive influence in this market, and if the algos were tripped into flipping short on the collapsing war risk, they may have simply overpowered the macro-driven buyers of the shiny metal. As of the European Open on Thursday, we're just above a key support level formed by the 200, 100, 55, and 34-day moving averages and the 38.2% Fibonacci retracement level, which are all clustered together between 1934 and 1950. My hope is that this cluster of support will contain the selling. The bullish macro view, which I agree with, that real yields may have peaked, will take over and gold will reverse course to the upside. But if we get a daily close below 1934, then it could be a lookout below situation. And if you believe the market lore that all gaps must be filled, well, there's still a big gaping gap from the October 7th event way down at 1848. That's fully $100 below the current market. The other support levels on the way down are the 50% Fibonacci retracement level at 1922 and the 61.8% Fib level at 1829.
I look at gold a little more simple. With such an extraordinary run in gold in the month of October, it is very technically common to have mean reverting corrections. And here we are near a 50-day moving average. We easily can drop down towards the 1900 to 1950 zone. But this reversal was meaningful, and it'll be really interesting to see whether the bulls can hold the line and defend all further corrections, and whether we see the price action start to consolidate back toward 2000. If we do, that would be generally pretty bullish. And so let's see whether or not the buy on dip happens here.
Now, Eric, earlier on, you mentioned you had some thoughts on fixed income. What's on your mind here?
As I noted in the gold commentary, there's a growing consensus that the bottom is in for the bond market. Peak yields are behind us, and it's all uphill in price and downhill in yields from here. I'm not sure I agree on the bottom call longer term, but in the short term it seems clear that a new bond market rally is in play. On a related note, we got a few emails after Harley Bassman recently got a huge amount of attention in the trade press for his PFIX ETF, which offered a convexity-efficient bet on higher interest rates and has returned over 200% to investors over the last 18 months or so. Several of you have asked us whether that's the same strategy Harley described in his September 14th MacroVoices interview. The PFIX ETF is not the MBS strategy that Harley described in that MacroVoices interview. PFIX is a bet on higher interest rates, and the reason for the outsized returns was that Harley nailed the call on higher treasury rates before the big move toward higher yields actually began. But PFIX is still, at its core, a bet on higher interest rates. So PFIX only makes sense to buy now if you think rates are headed still higher, or if you're buying duration and want to efficiently hedge the risk of being wrong. The strategy for trading mortgage-backed securities to get higher yields than investing in treasuries, which Harley described in his September 14th MacroVoices interview, is a completely different animal. Now, that product just began trading this week under ticker symbol MTBA, Mike Tango Bravo Alpha. And to be clear, there's no reason to expect 200% returns on MTBA just because it's managed by the same guy who came up with PFIX. MTBA is a much more conservative strategy designed to beat the U.S. 10-year Treasury note by about 150 basis points annually. It does that by employing the unlevered mortgage-backed security strategy that Harley explained to MacroVoices listeners in his September 14th interview. That product began trading this week at $50 and is expected to deliver a dividend of about 25 cents per month. It's a strategy to consistently beat the yield of the U.S. 10-year Treasury by about 150 basis points as a core fixed income holding, not as a speculative instrument, as was the case with PFIX.
Yeah, Eric, on page 9, I have that 10-year Treasury yield, and we can really see that rejection at 5% happen, and now we're seeing us correcting off of this level. It'll be really interesting to see whether the highs of bond yields are in for at least this year, and if they are, what will that impact be on risk assets, particularly those bond proxies that are most sensitive to it. But I also included on page 10 that chart of the PFIX, and Harley's product has just had a great run on the upside, but just in its very name, it's a interest rate hedge, and it's meant to be often paired with being long bonds. And nonetheless, it worked spectacularly. It'll be interesting to see whether or not that is a short-term high at the same time if yields have peaked. Nonetheless, I wanted to wrap up by looking on page 11 at the natural gas futures. I particularly highlighted the December one. And what one would naturally think is that these going into the winter season, that there would be room for a lot of these natural gas contracts to potentially rise. Certainly, as we're rolling up the term structure, the continuous chart will have that effect. But when you're looking at that December or the January contract, here we're breaking to lower lows. It's really interesting to see how nat gas continues to be actively distributed. There's simply no sign of a bottom here. It'll be interesting to see whether or not this finally turns around, or whether there's still one more leg lower going towards $3 here.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.